In this video, we're going to be covering some of the underrated ETF dividend players in this space for option income. And I think we can really learn from what Global X is doing with some of their income ETFs, and hopefully some of these newer ETF issuers take notes. And it seems like they're really going to that direction. So Global X has been out for quite some time now. They have XYLD, QYLD, which have been out since 2014. So they have been in the ETF space for quite some time. And the ETF we're talking about is going to be QYLG, which is the NASDAQ 100 covered call and growth ETF. So it's going to be very similar to some of the ETFs, say by Defiance, from their growth and income ETFs. This one has been out since 2020, and it does have a 5-star Morningstar rating, which is kind of crazy to think that it actually got 5 stars. And this is out of 77 derivative income funds, risk-adjusted returns based on August 31st, 2025. Now let's go over the reasons to consider QYLG, and we'll go over the underlying strategy as well as the distributions and the stock price as well later in this video. But the reasons to consider this ETF, QYLG, and I think this is going to be an ETF that resonates well with a lot of the income investing community. But you're going to have high income potential. It's going to seek to generate income by, of course, writing covered calls on the underlying index. In this case, it's going to be the NASDAQ 100. Now, they do have LG, which is going to be on the S&P 500 index, but these ETFs are going to be different than traditional covered call ETFs. And we do want to note they also have QYLD, which is going to be the NASDAQ 100 covered call ETF. So it's not really going to have any growth. And that's one of the reasons why I prefer QYLG over QYLD. But QYLD is going to have a higher dividend yield. It's going to have monthly distributions, but there's not going to be much in terms of upside potential, because there is going to be one main difference between this one and the other one. And QYLD is it's going to have 100% covered calls on its underlying, versus QYLG, you're going to have upside potential. It's going to write covered calls on only half of the portfolio. So the strategy allows long-term investors to capture half of the upside potential of the underlying index, which is something that a lot of income investors really want these days. They don't want the upside potential capped, because that leaves a lot of room for downside risk. And during market recoveries, you want to capture those rallies. You don't want to miss out and sit on the sidelines. Now, if we take a look at the fund details, we can see net assets under management is going to be right around $118 million, and it's going to have a fairly low expense ratio of 0.35%. Because it pretty much has a very straightforward strategy. It's not doing options every single day like YieldMax or Defiance or Roundhill, where a 1% expense ratio is justifiable. So 0.35% is going to be a bit lower, which is very good to see. And here's where it gets very interesting. Going over to the distributions as of October 3rd, 2025, we can see the distribution rate is going to be 5.75% distributed monthly. And here is where a lot of people are confused about. The trailing 12-month distribution percent is actually 22%. Now, how can the forward-facing distribution rate be just under 6%, while the past 12 months, 22%? If we head over to the distribution history check for 2024, we can see December 30th, 2024, they actually pay out a special dividend, pretty massive, of $5.29, which has kind of inflated the trailing 12-month distribution yield. So a lot of investors look at this ETF, they think it has a 20+% dividend yield. As we can see on stockanalysis.com, it has 24%. That is actually not the case, and it's purely because of this massive payment, this massive special dividend it paid out in December. Now, I'm not too sure how they came up with this $5 dividend. It's likely because they made a ton of profits, because 2024 was a pretty good month for a pretty good year for the NASDAQ 100 index. So they probably made a lot of profits and they're just returning that to the shareholders. But taking a look at the chart all time, we can see it's up 10%. So it's pretty good in terms of NAV stability. It's not going on a continuous decline. Now, of course, we do have rises and the dips, and it's just going to move with the underlying index of the NASDAQ 100. But we're seeing that it does have that upside potential from mid 2022 to all the way to 2024. We have that very nice upside capture. So we're not sitting on the sidelines during these market rallies, which is something that's really good, especially if you don't really need all this income immediately. You want your underlying ETF to grow in price and you have a long-term time horizon. And its sibling ETF, which is going to be XYLG, is going to be the same strategy, covered call ETF and growth. It's only going to write covered calls on half of the underlying, but it's going to be on the S&P 500 index. And if you're aware of the S&P 500 index, it's a little less volatile, but we can see something pretty interesting here. It's up 16% on share price alone since 2020, which is 5 years from now. And these ETFs have been out for 5 years. They both came out on the same date, September 18, 2020. And we will compare the total returns to see which one is better, QYLG or XYLG. They're very similar. XYLG is going to be a little less volatile, so you're not going to see huge dips compared to QYLG. Now, of course, it is going to drop with the overall market, but it is going to be a little bit more stable in my opinion, and it's also going to have a lower distribution rate because the S&P 500 is a little bit more diversified, a little less volatile, in return, a little less income as a trade-off. Now, if we take a look at the total real returns of QYLG and XYLG, we can see year-to-date, QYLG is up 10.54%. Compared to XYLG, it's up 8.45%. So it's pretty comparable. XYLG is going to have a 2% more year-to-date return. But if we take a look at the chart for the total returns, we can see this red line is going to be the NASDAQ 100 index, QYLG, and the blue line is going to be the S&P 500, XYLG. So we can see that there is going to be a little bit more volatility involved with QYLG. That's just the nature of the NASDAQ 100 index versus XYLG. It's a little bit more stable, but of course it's not going to rise as much in huge bull rallies. Now what's very interesting is we compare the total returns since September of 2020. It's going to be very comparable. We can see QYLG is going to have an overall return of 83.63% compared to XYLG with an 81.89%. So it's pretty much a 2% difference. And in my opinion, I'm a huge fan of XYLG for that reason. We can see in 2022, QYLG had huge market dips as the tech sector fell. XYLG was very stable, and if you're going to have similar total returns, you might as well go with the one that's a little bit more stable. And even though QYLG has a 5-star morning rating versus a 4-star for XYLG, these are both great ETFs. They're very comparable. You can't really go wrong, in my opinion, with one or the other. But for my purposes, I want a little bit more stability from an ETF such as this. So XYLG would probably be the one I would choose. Now, if we take a look at the distribution rate for XYLG, it's only going to be 4.46%. Now, of course, the trailing 12-month is going to be 21%, but that was because it also paid out that massive special dividend in December of 2024. So that's inflating the trailing 12-month. And in my opinion, the better one to look at is the forward-facing distribution rate, which is based off of the last distribution. So this one is going to be about 1% less distribution from QYLG, which is going to have 1% more. Now, of course, these are not going to be high distributions by any means. the ETFs by NEOs like QQQI and SPYI are going to have a much higher distribution rate, paying out monthly, of course. It's going to be 14% for QQQI and around 11-12% for SPYI, which are going to be very good competitors to these ETFs. Now, if we want to compare all four of these ETFs, we can see SPYI and QQQI have both outperformed QYLG and XYLG by a pretty big margin. Why are we even talking about QYLG and XYLG? Well, I think that the underlying strategy behind these ETFs, which is going to be writing calls only half the portfolio, allowing the underlying to have that upside capture, is going to be a new trend, and it's what we're going to be seeing from these ETF issuers evolving their ETFs to allow some more stability with their ETFs in return for a little less distribution rate. Now, if you do want higher distributions, a lot of these ETF issuers are going to utilize leverage to juice up the premiums a little bit. We see Granite shares with their yield boost lineup do this with their 200% leverage ETFs, generating massive income. And we're also seeing NEOs come out with some of their new boosted funds, which should be here in about 2 months from now. So you're going to see ETFs such as SPYI and QQQI have a much higher distribution rate than it normally is, which is around 13-14%. And that is pretty much the reason why a lot of these ETFs by NEOs have been so popular lately. They've been stable, they've been reliable. Even though it does move with the market, we can see it dropped pretty significantly in April 1st. It does have that recovery potential to move with the market. And as we know, the markets are pretty much always going to move up and to the right in the long-term time horizon. Now, the short term, it is going to have some dips, but overall, the market always does recover. And if you're a long-term investor, this is perfect for you. But this is pretty much the ETF that has started it all. It's going to be QYLD. It has $8 billion assets under management. It's been out since December 12, 2013. So it has been out for over a decade. It's been out for quite some time now. It has a 13% dividend yield, but we can see it does have that erosion that a lot of people just do not like. It's down negative 32% since all time, which is not too bad. But if you're only going to be getting 13% dividend yield, you want something a little bit more stable. And in my opinion, you might as well just choose QQQI, which has a similar dividend yield, but you're going to have that stability and the upside capture that we're not really seeing with QYLD or even XYLD, which is the S&P 500 covered call ETF, where it's writing 100% covered calls on the underlying. Now, this one does not look as bad, and that's because the S&P 500 has been pretty stable. It does have a similar 13% dividend yield. And in my opinion, this one is really solid compared to QYLD. So I'm a huge fan of their X lineup, which is going to be the S&P 500 index versus the NASDAQ 100 index. Going to be a little bit more volatile. They are not going to be able to capture the stability as well either. So let me know down below what your thoughts are on XYLG. Personally, I'm a huge fan of the NEOs funds, but I think this is really going to help pave the way, and a lot of ETF issuers can learn from XYLG and QYLG from this upside potential strategy of only writing calls on 50% of the portfolio while leaving room in the underlying to run up during bull markets. Let me know if you're actually owning some of these ETFs and what your favorite covered call ETFs are for both growth and income down below.